Good to see you, Carl.
So you got a couple things going on. We obviously know we're in a pretty good season from a seasonality standpoint, but it's clear these supply chain and cost pressures are going to be with us for a while. You got central banks starting to move, the Fed's next week. What is the playbook right now?
Well, I think it's to focus on a lot of what Bob just talked about. Profit margins are really high. And, you take a look at this morning's employment cost index. It was up 3.7% from a year ago, but that's still less than the pace of inflation at 5.4%, reflecting declining labor costs on a real basis. And that's helping to sustain these profit margins. I think as we see an ease in some of these supply chain log jams, which already appears to be underway, that's going to ease some of these transitory supply pressures that have been pushing up inflation. You've got also, an improvement in the macro outlook. Yes, we've got concerns about tightening, but maybe less tightening in China. Evergrande contagion concerns faded this month. That certainly led to some of the improvement in the stock market here in October, including in China, where stocks are up in a similar amount than they are elsewhere in Europe and the U.S. So, I think we've seen some of those concerns fade a little bit.
Interesting. U.S. Steel today. We're delighted to hear from multiple auto customers who are foreshadowing that the trough of the chip shortage could be behind us. They're beginning to build or add to Q1 build schedules, indicating to us increasing usage rates beginning as early as next week. I wonder, Jeffrey, if you think the market has discounted that yet.
I don't think it's discounted yet. I think when you take a look at some of the manufacturers and the numbers they've been reporting, they've been beating, but their stocks often have been down on the day when they reported. I think there's still lingering concerns about the supply chain issues, particularly in industrials and consumer discretionary areas like autos. That should be beginning to lift. Carl, we often see that, gluts don't lead to shortages, but shortages often lead to gluts. It'll be interesting to see over the next year or so what happens with semiconductors and other things that are currently in shortage in the supply chain.
Yeah, which, Jeff, brings me to a question about something you've written about in your note, which is the shift from goods to services. I mean, certainly we saw the focus to goods and more manufacturing and industrial parts of the economy through the pandemic last year as everybody was locked in and at home buying things. But as the world reopens here and as we do see that shift back to services in a more meaningful way, how does that factor into this conversation, and what does it mean for the investment thesis going into 2022?
Yeah, services have been booming. They've actually been really picking up the slack from the weakness in manufacturing tied to those supply issues. And that's key. I think you do want to look at more service-oriented businesses right now. What's a great performing sector? Financials, healthcare, I think, is poised to come back here as well. Services are really doing very well. And I think the market has discounted that, been really focused on the rebound in demand for physical items. But as we transfer into the next stage of demand, I think that's going to be a big area. So I think it's an area you want to take a look at. Stocks have been reacting very well in the service sector. When service companies have been beating, their stocks have been going up. I think that's a sign that may continue here through the fourth quarter.